Dobrý den, vážené dámy a pánové, vítám vás u dnešního webináře, který se jmenuje Dividendové investování jako investiční strategie. Spolu se mnou je tu Caroline Pierce, zástupkyně společnosti Fidelity International. Hello, Caroline.
Hello, thank you for having me.
Tenhle ten webinář bude v angličtině. Agenda webináře je, proč jsou dividendy důležitou součástí vlastně investičního portfolia pro klienta, proč je dobré mít v portfoliu i dividendové strategie, jestli dává dividendové investování vlastně v dnešní době smysl a jak se porovnává s klasickým investováním.
So why are dividends important? Well, I think dividends are important for three very good reasons. The first of which is that dividend payouts are relatively stable irrespective of the economic cycle. And by that I mean that investors can generate a reliable source of income regardless of what's going on in the macroeconomic environment. And if you look at the next slide, you'll actually see that consistency. You can see that while bond yields have compressed quite significantly over the last 25 to 30 years, the equity market has gone up and down and there's been volatility behind that, but dividends have been relatively stable across this period.
And that is because the bond investors are basically orienting themselves based on the interest rates that are set by the central banks?
Yes, well, I think that has been a factor. I mean, I think certainly we've seen over the last 5 years that, the actions of central banks have pushed investors up the risk spectrum in search of what is an adequate level of income. And that has, in effect, forced down the yields on cash, government bonds, and other fixed income instruments. So another good reason that dividends are important is that they are sustainable and growing dividends are linked to strong returns over the medium to long term. And we've actually got some analysis here to show you that. What you can see here is essentially the MSCI All Country World Index, so 2,500 stocks, the total return of those stocks, the price return of those stocks, and the volatility associated with those stocks. Then we've compared it to a bucket of dividend aristocrats. And here we've used companies that have consistently grown their dividends year on year for 10 years. Now, what's interesting about this analysis is that you can see not only is the price return higher, the total return is obviously higher as you chip in that dividend and compound it over time. But this has been achieved with lower volatility than the broader equity market. So that's a very attractive quality of those consistent and growing dividends.
So it almost seems as a riskless trade, right? You have lower volatility and then a higher total return.
Well, it's true. It's something that the efficient market theorists, wouldn't be happy to see, essentially. But that is the case, yes. And then finally, dividends are important because they promote good capital discipline from company management. So, the characteristics of good dividend-paying companies are generally strong balance sheets, very cash generative, very resilient earnings streams. But the opposite can be true. If you don't pay a dividend, then you could be subject to pet projects, for example, managements that are willing to go out and make value-destroying acquisitions as well. So it's actually a very good way of creating shareholder value and keeping managements honest, in a sense, yes.
So basically you're saying that if the company pays out the dividends, that it doesn't have cash to do stupid things, right?
Well, yes, I guess that's true enough. Ideally what you'd like to see is a high-quality company that generates enough cash to pay out an acceptable level of dividend to its investors, but also then reinvest back in its business and grow its earnings and then grow that dividend to get that combination of a dividend today plus dividend growth down the track. So I think there are three very good reasons why dividends are important.
So why do you think that dividend investing is important?
Well, if we look outside of that, so that's, we've talked about why dividends themselves are important, in respect of company management, etc. But what about dividend investing as a style? Well, I think that comes back to a theory or something that's often well known by investors but is forgotten. And that is the fact that dividends and dividend growth are the key drivers of total return over the longer term. So we've got an interesting chart that shows you essentially what is a long-term series of equity returns from the US market, so 110 years of equity returns. It shows you the total return that's been achieved over that period, as well as the price return that's been achieved over that period. And what's very clear, if you look at this analysis and you look at the two boxes, so the real total return in the top box, the light blue box, is 6.3% per annum, whereas the real capital return, so that excludes dividends, is only 1.9% per annum. So you can see there that 2/3 of your total return has actually come from dividends and the reinvestment of those dividends. The second thing to note, I think, is the power of time. And that is, the longer you invest, the longer you see this compounding, the magic of compounding work. An end value of only $8.50 from a capital return over that period versus an end value of $851 on a total return basis.
Because the investors reinvest the dividend that they get as cash, and then they invest it into stock that pays another dividend, so there's a compounding, right?
That's exactly right. So that is compounding. It's a very powerful driver of long-term total returns. So we've looked at the power of compounding, and there I've used, as I said, a data set from the US, a very long time series, and that's the reason I've used that. However, what I wanted to illustrate now is that this phenomenon, the fact that dividends and dividend growth are such key drivers of total returns, is the same regardless of where you invest. So we have a slide here that's actually come from SocGen, and just shows you across various markets the real total return that's been achieved by these markets since 1970. We've broken it into its various components of dividend yield, dividend growth, and multiple expansion. And what you can see there is that while multiple expansion, or whether the market gets more or less expensive, has varied over time, can be transient depending on where you invest, the fact is that dividend and dividend growth are consistent regardless of where you invest, and have been pretty much the whole story in terms of the total return of those markets over time.
Yes, they look relatively level when you see the different regions.
Absolutely.
Just with the exception of Japan, probably. But that's changing now, right?
Yes, fair to say. The Japanese market, we've seen some shifts there in terms of their the capital discipline, investing for shareholders. So we've seen buybacks within the Japanese market. We've seen good levels of dividend growth. So the attitude to dividends is certainly starting to change in Japan, and I think that will be reflected over time in terms of what drives their total return.
So basically nowadays it can be said that all developed markets are shareholder friendly and pay an attractive level of dividends.
I think more and more so. The attitudes to dividends still vary depending on what market you invest in. But by and large, I think, a low interest rate world, a low growth world has meant you've seen that managements of companies, giving their shareholders what they want, and that is an acceptable level of yield where possible. So we have seen a slight shift, which has varied from market to market, but nonetheless it's been a positive development.
So what type of investors can invest in a fund that invests based on the dividend philosophy, basically?
Yeah. Well, the great thing is, dividend investing can appeal to a wide range of investors. So if we start with, someone who's relatively young, someone new to the equity market, for example, they may have a high risk tolerance, they've got a long time horizon to work with, and therefore dividend investing for them, they might be looking for the long-term capital growth that you can see from taking your dividends, reinvesting them, and compounding them over time. And we've seen how powerful that can be. Also, it's a good strategy for someone who has a lower risk approach to equity markets, because it's at the more risk-averse end of equities, but someone who still wants to save for the future. So they could use that compounding effect as well. And then also for those people who are in the retirement phase and who are looking to take the income. So as I said, the yields remain relatively stable across dividend equities over time. So, as part of an income portfolio, this can play a very good role.
Right. So how does investing in equities compared to other asset classes?
Well, obviously, you have to take into account the risks that investing in equities entails. But one of the attractiveness, I think, particularly when you're talking about dividend investing, is that this is a real asset class, whereas fixed income or bonds, let's remember, is a nominal asset class. So the fact is that if you have a well-managed dividend strategy that invests in companies with healthy dividend yields that grow over time, what you actually get is a real yield. So if you can get those dividends to grow ahead of inflation, you get a real yield and therefore some protection from inflation. And that's something that bonds can't offer.
Because they don't grow to value.
Exactly. I mean, if you think about the distribution or the coupon that comes from a bond, it remains stable over the life of that bond by and large, unless it's linked to something. Whereas an equity...
And it has a set price and maturity, right?
Exactly. So, that's another benefit of dividend investing over just purely investing in bonds, I think.
All right. So can you walk us through the comparison on another slide?
So now I thought I might just touch on, why is dividend investing popular, or why is it a sensible and appropriate strategy for investors today? And I think the next chart here, it's very interesting, and it's a very neat summary of where we sit today. What it essentially shows you is that the yields on a series of different asset classes, both pre-financial crisis, so in June of 2007, and then as we sit here today. So those yields pre-financial crisis are the boxes, and the yields that we sit here today are the shaded areas. And there's two things that I want to draw out of this chart. One, essentially what you can see here is that the actions of central bankers around the globe have pushed down yields on cash and government bonds and other fixed income instruments, and basically pushed investors up the risk spectrum in search of an adequate level of income.
Basically any security that's linked to an interest rate, right?
Yes, very much so. So the low interest rate environment has meant that investors have been forced to seek income elsewhere. You just can't get it on your deposits at your bank anymore, for example, or within government bonds, an acceptable level of income. So that's one phenomenon you can see. And you can see that this compression that we've seen across cash and fixed income is very substantial. Whereas equity or dividend, the yields that come from dividends, the yields that come from equities have remained stable, or in some instances have risen, are higher than they were pre-financial crisis. So this speaks to that relative attractiveness, I think, that we can see between dividend equities and the fixed income and cash areas of the market. And the second thing I want to draw out from this, and as an equity investor, I think it would be remiss of me not to mention, and that is that equities are a real asset class, whereas bonds are a nominal asset class. And in that respect, if you can invest in a portfolio of equities where the dividend can grow ahead of inflation over time, what you'll essentially be left with is a real yield, okay, as opposed to a nominal yield, which is what you will get from fixed income instruments. Which is
negative right now on cash.
Exactly, and this is so important. If you look at the next slide, what you're seeing here is essentially, the rolling 3-year real return that comes from cash. And you can see that, in terms of the erosion that's happening in terms of your real wealth is at the same levels that it was in the 1970s. But let's remember, in the 1970s, while inflation was very high, interest rates were also very high. That's not the situation that we find ourselves in today. So, investors are really struggling to find what is that real yield.
So if we compare dividend investing, if we don't take into account cash, how does it compare against inflation?
Well, yes. So, if we extend beyond that, if you look at the equity market, all you've got to do is draw a comparison, and we've done this here. If we compare the yield on the MSCI Europe versus the European inflation rate, what you can see is it has been consistently higher. So it has been able to provide you with that inflation protection, that inflation hedge.
So can you summarize why dividend investing is attractive in comparison to other strategies?
You know, dividend investing is very important, I think, for a couple of reasons. Firstly, dividends can provide, you know, that positive real yield, as we've just been discussing, at a time when cash and fixed income instruments just can't do that.
Sure.
But let's go back to the previous argument about this power of compounding. And the fact is that dividends and dividend growth are two of the major drivers of total returns over time. And therefore, dividend investing can be attractive for those investors that are looking for long-term growth from a portfolio as well.
Sure. I'd also like to remind our viewers that we invest when we use the Fidelity Global Dividend Fund and also other dividend funds in our extended offer. We use reinvestment classes that basically take the dividends that the portfolio the fund gets from the underlying investments and then reinvests them into other holdings. So they don't distribute dividends, and there is basically a simple reason: because of tax in the Czech Republic. It's more advantageous to do that than to redistribute dividends that you would always have to tax.
So I think these last couple of slides that we've been through help to explain why I think dividend investing is so attractive for investors today. You know, the scarcity of real yield essentially means that an equity income strategy, certainly one that puts the delivery of a good headline yield, but importantly a dividend stream that can grow over time ahead of inflation. If they put that at the heart of its approach, you know, that's a very attractive proposition for investors right now. But let's remember, dividend investing not only can provide that real yield and the income today, but can also be a good strategy for capital growth. And I think, you know, that by investing in stocks that pay dividends, and more importantly, those that can grow their dividends as well, that's the best way of capturing value from stock markets over the longer term. And as we saw, you know, throughout history, that compounding effect of reinvested dividends accounts for the bulk of total equity returns over time.
So that's interesting. Thank you, Caroline, for being with us today. Děkujeme i našim posluchačům. Veškeré webináře si můžete současně prohlédnout i na našem YouTube kanálu, který se jmenuje ING Bank Česká republika. Můžete se tam přihlásit vlastně i k odběru dalších webinářů. Děkujeme vám za pozornost a těšíme se na shledanou u dalších webinářů. Děkujeme. Thank you, Caroline.
A pleasure. Thank you.